Hello, everybody. Welcome back to the Covered Caller. My name's Max, and at my channel, we like to talk about these high yield option based income funds all day. All right, I built a special metric called the MaxFactor, which I use to study these funds and try to pick out the best ones. Now, if you just go by yield, it can be deceiving. You definitely don't want to just take the highest yield fund, in my opinion. Let me show you what I mean, and then we'll get into the list real quick. One of the most important things to remember is high yield does not equal a high return. There's a sweet spot where a yield can be high enough to be interesting and high enough to be a huge premium over, say, bonds, but at the same time, not so high that it kills the NAV. Just like I've said a million times, a high yield is a tax on the future NAV. The future of the NAV's upside. A high yield is a tax on that. But there is a sweet spot. This week it's around 18.2%. Now, it doesn't mean there's some funds that can't have a high yield and still have positive return, but they're outliers. CHPY, TSMY are examples this week, but there's also numerous examples, as you know, many more of them, of funds that have a super high yield and poor NAV return. The MaxFactor tries to weed out the noise and find the ones that are the best overall. Now, here's some ones that did well this week from different companies. BlackRock had a good showing with some efficient funds. NEOS, kind of a perennial stability type company. Then we have First Trust that's made an appearance on the list for only the second time this week. All right, let's get right in the middle of the countdown. Number 20 is KSILB. All right. Now this one's from Curve. It's based on the SLV, which is a silver ETF. Howard does a special strategy with this. Howard Chan's the portfolio manager, and actually he has a trader, but they have a special strategy they use that allows some of their funds to seemingly get large parts of the upside without hurting their NAV as much as others. Anyway, in KSILB, they use a little bit of leverage to accomplish this, but this thing's been an absolute rocket ship lately. 90 days ago, the price on this was $25. Now the price is $37. This thing has got straight up, and the funny thing is the price has been like $58 this quarter too. It's down from 57 or 58 down to 37. Silver took a big drop at the first of this last month or at the end of January, but it certainly affected KSILB, but KSILB is still doing well enough to be number 19. Now, the Achilles heel for KSILB, and the reason it's not ranked higher despite all this huge NAV return and a good yield of 21%, is the stable DEX. A 0.11 is a poor score. It's one of the least stable ones on the list tonight. So let's see who number 19 is. Number 19 is DOGG. Okay, now this one is the opposite end of the spectrum. This one is a 130, a 1.3 on the stable DEX. Good job. This thing's 30% more stable than the broader market. And in addition to that, the NAV's gone from about 21 bucks, just under 21, to just over 23. That's not bad. That's about 10.5%. 1 year total return on this thing is 19.5%. It's based on a strategy called the DOGGs of the Dow strategy, and they sell options on top of the DOGGs on the Dow strategy. Well, the DOGGs on the Dow strategy is a value investing strategy. Values back. You're going to see a lot of value-based funds on this list tonight. All right, number 18 is HDLB. Okay, this one is interesting. This is the second time this has been on the list. So let's go take a look at the FinViz page for this. Okay, this is the E-Trax or UBS monthly pay, double leveraged US high dividend, low volatility ETF. I'm going to say that this is a similar strategy to the DOGG strategy, which is the DOGGs of the Dow strategy. They also, that strategy also attempts to identify high dividend and low volatility or more value stock plays. So I'm seeing a interesting battle royale shaping up. Let's run HDLB against DOGG. And we'll run it since inception and then for the last quarter. Since inception, you can see that HDLB has had a nice run of it. DOGG's been doing well this past year. It is something that I always like to notice. In the sell-off, DOGG protected capital better than HDLB. HDLB definitely looks riskier, at least on this. Now let's look at this just this quarter. And I would expect I'd expect HDLB to do better this quarter also because it's ranked higher on the daily factor. And the daily factor really emphasizes the past quarter. But I would also expect them to be close. And not really too close. HDLB has pulled away. All right, back to the factor. That would explain why HDLB is ranked one spot ahead of DOGG. All right, let's see who's next. WEEI. This is from Westwood. This is an energy-based infrastructure ETF, yielding about 11.5%. NAV's good. NAV's up 11% just this quarter, excluding dividends. The 1-year total return, which would be dividends and NAV return together over the past year, about 15.87, very respectable. Also, speaking of respectable, this one has one of the better stable dexes we've seen yet. It's not as high as DOGG stable dex at 1.3, but this one's at 0.88, meaning it's largely as stable as the market as a whole. It's actually about, call it 7/8 as stable as the market as a whole. All right, so let's see who is number 16. Number 16 is KOLD. All right, KOLD is from Curve. It is a brother fund or a sister fund to K-Silv. Now they're both based. One's based on silver. One's based on gold. They have similar strategies. And Howard does something where he levers up the synthetic just a little bit, and he tries to add a little extra leverage to offset the amount that the call is capping the ETF. Well, what this strategy is called is a Delta One strategy. They do cover calls, but they try to still preserve approximately 1-to-1 upside, NAV upside with the market. So they can't always do it. There's no guarantees, and options decay, and there's a lot of moving parts. But KOLD and K-Silv are doing a great job. Now, KOLD's up from 24 to 35. It also took a hit whenever the precious metals sold off big. Not quite as big of a hit as silver took, but it did take a hit. Well, despite all that, the NAV's up 44% for the quarter. Now, this isn't super stable, and part of that's because of using the little bit of extra leverage. It's not a lot of leverage. It's not double levered. It's strategic leverage, just a little bit of leverage. All right, but still, there's no free money. Leverage works both ways. I would expect KOLD and K-Silv possibly to do worse than the other gold-based funds that don't use just a little bit of leverage on the way down. So hopefully that won't happen for a while. Hopefully gold and silver will keep going up. In my high yield portfolio, I have about 6% in K-Silv of the whole model portfolio of the high yield portfolio, and about 6% in KOLD. And they've done well. I'm up year to date mainly because of KOLD and K-Silv. All right, next is GLDI. Now this is another one based on the GLD. Now this one is from UBS. It's interesting because it's right next to KOLD. So let's kind of look at them compared to each other. So GLDI has a higher yield just only has a lower yield than KOLD. It's only yielding about, KOLD yields 9, this one yields 16. GLDI has a higher yield, and GLDI is more stable, and may kind of explain why GLDI is ranked 1 point ahead. Now, to be fair, GLDI doesn't have nearly the NAV return that KOLD has, but it has quite a bit more stability. So you throw it all into the mix, and they're fairly close. Let's look at these. Let's look at GLDI versus KOLD. All right, so this is for the last quarter, and you can really see that one-to-one, that you could really see the leverage working on KOLD, and it's going to work great on the way up. However, leverage works both ways. Look at the amount the GLDI dropped in this pullback. Barely anything compared to KOLD. So two totally different funds, but when you factor in that one's a lot safer than the other, they're similar type risk to reward. At least this week they are. All right, so let's go to number 14. Number 14 is a closed-end fund. I know my friend Brad will be happy about this closed-end fund. He's a closed-end fund guy, and I know a lot of my other subscribers and watchers are as well. So FAX is the Asia Pacific, the Aberdeen Asia Pacific Income Fund. The NAV on this doesn't look as good as the NAV on gold. I mean, but it's pretty stable, and this ETF's traded in a range over a year between 14.50 and 17 bucks. That's a pretty tight range, and I would expect this to have a pretty high stable dex. So let's go back and look, and sure enough, the stable dex is a 1.29, which is about the same stable dex as something like DOGG. So these are definitely safer type high yield funds. At least they have been lately. So this thing yields 12%, NAV's +7 for the quarter. 1 year total return's good. Stability's good. That's a solid closed-end fund right there, coming in at number 14. So let's check out a number 13. Number 13 is XLEI. All right. Well, this one's based on energy, not really infrastructure, but energy companies. Let's compare this one to the WEEI, the Westwood one, kind of in the same business. First of all, on stable dex, XLEI is an 86. So, but let's just run XLEI. Well, first of all, let's look at XLEI. All right, hasn't been around for a year yet. It's based on the XLE, and the companies in the XLE are Exxon, Chevron, Conoco, Williams, usual suspects, Phillips, Valero, Baker Hughes. Now let's compare XLEI over the past quarter. Okay, now this is a close call. Looks like Westwood tops it a little bit, but I would bet you that XLEI is a little bit safer on the stable dex, and that might be why it's ranked a few spots ahead of it. All right, so let's see who is number 12. Number 12 is USOI, another oil-based ETF. Now this is from UBS. This thing's been around for a while. Anyway, it's not as stable as the last one. It's not as stable as XLEI. It's only about a 0.65 on stability, meaning it's 65% as stable as the broad market. All right, well, the yield's 23%. The NAV's good. It's up about 8%. 1 year total return isn't great. Oil hasn't done great over the past year, but it's been doing really well over the past quarter. All right, let's see who's 11. IWMI. This is our first fund on the list from NEOS. NEOS is the parent company of SPY and XQY, two wildly successful ETFs that I know a lot of you guys like. Spoiler alert, neither of those ETFs made the list tonight, but IWMI is based on the Russell. Russell's been hot. Russell 2000 has been outperforming the NASDAQ, especially lately. So really doesn't surprise me that IWMI is on here and XQY isn't. The NASDAQ's been a little weak lately, especially on a comparative basis. We're still close to all-time highs, but the Dow and the Russell have been leading the way the last month, and we certainly see it in the rankings. All right, this thing yields around 14, actually around 15%. NAV went from 46 to 50 bucks, so that's solid. 1 year total return solid at 20%. The stable dex is basically the same stability as the broader market, so this one could be a good option for you if you're looking for some Russell 2000 exposure, and 14 or 15% yield will help you. Number 10. Number 10 is XLBI. Now this is from State Street. This is our second one from State Street. Yeah, we've also had XLEI from State Street. Okay, XLBI is based on materials, building materials. Let's look at it here. It's called a Material Select Spider Premium Income ETF, but they trade options. They sell options on the XLB, which has been on fire lately. Now let's look at the top 10 stocks. In this one, you have Newmont, you have Freeport-McMoRan, you have Sherwin-Williams, you have a little Nucor, Martin Marietta. The biggest company is Lind. Anyway, nice job. That sector has been on fire. If 14.3% yield will help you out, that might be a decent way to get exposure to that part of the economy. Let's see who's number 9. RDTY. Now, on my live stream last night, I mistakenly said this was based on Reddit, and I don't know what I was thinking. I apologize so much. This is based on the Russell 2000. It's from YieldMax, and this is a zero DTE strategy where they sell zero DTE covered calls. They sell them, and they actually sell even less than a zero DTE, or they write options in the morning and take them off by the end of the day. So this is an uncovered at night strategy, similar to maybe some other companies have a similar strategy where they only sell covered calls during the daytime and then they're uncapped at night. So that can help lots of times. That can help if the market rallies at night. So RDTY, now let's look at this thing. It's yielding 41%. Wow. And the NAV's not great. It's just gone from 39 to 41, but it's only 4%. But I mean, it's kind of making up for it on yield. We could compare it to something like IWMI from NEOS that's based on the Russell also. Now, IWMI only yields 14.8%, but the NAV's doing way better. The NAV's up 20%, where the NAV of this one is just up 4%. Let's look at RDTY and IWMI over the past quarter. So RDTY from YieldMax and IWMI from NEOS. And this is very close. It looks like one's 9.4 and one's 9.5. The YieldMax fund gets it by just a little bit on total return, and that's particularly impressive when you consider the YieldMax fund is more volatile and pays a higher yield. Generally, with the higher yield, you get less. You definitely get less NAV return, but sometimes the less NAV return also causes less total return. Well, we're going to call this a tie, but both of these guys are doing well. But this is a standout week for the YieldMax one when you consider it's paying 3 times the yield. All right, but one of those, neither of those could work for you. Check with the planner. Okay, number 8 is XLEI. So this is another State Street one. So let's just kind of take a look at it. So the XLEI is industrials. I think of Dow Jones when I think of industrials, and I think of the companies in the Dow Jones, and a lot of the same companies and those same types of big industrial companies, big, huge business are in the XLI. We have GE, Caterpillar. We have GE Aerospace and another division of GE. We have Boeing. We have John Deere, Union Pacific, Honeywell. I mean, that's pretty darn blue chippy. And lately, blue chip, big, old industry has been doing well. I mean, heck, this thing's, on the XLI is up from 150 to 177 in like 3 months. So that's the underlying they're writing options on. And so that makes the return of the option-based fund, the XLEI, a lot better. And we can certainly see it. I mean, it's up 8% on NAV, paying a 10% yield, and it has the highest stable dex we've seen so far at a 1.67. That's really good. All right, let's see who number 7 is. Number 7, the River North Opportunities Fund, another closed-end fund. Let's pull up a kind of a longer-term chart of this. Heck yeah, this has had a good year. Looks like it's gone from 10 to 12. And paid a monthly payment along the way. This is one of those closed-end funds. Yielding 12, good NAV return, super stable, 1.54 on stability. That's a great job. Let's see who number 6 is. Number 6 is another one of these darn closed-end funds. These things are everywhere nowadays. Now, this is a good one. This is the BlackRock Capital Allocation Trust. This thing has moved from around 13 to around 15 over the past year. If we look at the metrics here, yielding around 21 lately. Over the past quarter, the NAV alone's +7. I mean, that's good. Really good. The stable DEX is 0.95. Great job, BCAT. Let's see who number 5 is. Number 5 is GDXY. Thank gosh it wasn't another one of those closed-end funds. Just joking. We'll put the MaxFactor someday might have all closed-end funds on it. Who knows? It just depends on which one's doing better. The MaxFactor, you know, is just it's just math. So speaking of math, GDXY has some attractive math here. This is based on the GDX, which is gold mining. This is from YieldMax. This thing's been yielding around 52% lately. Price has gone from 15 to 17, almost 17. You know, a little over 15 to nearly 17. I mean, it may not sound like much, but it's 11%. And when you combine that with the 52% yield, that's not bad. Now, this fund definitely probably got marked down a little bit because of the lack of stability. But still, when you look at the other metrics, this is the 5th best performing fund on a risk-adjusted basis, at least this quarter and at least by this metric. All right, so now let's look at number 4. Number 4 is MRIE. All right, MRIE. So this is one that's kind of, you know, that a lot of people loved to hate last year, but it has definitely made a turnaround. Now, the reason it did so poorly is because it's based on Moderna, and Moderna had done very poorly also, but not as much lately. All right, so let me show you what I mean here. Here is MRIE. And MRIE has gone from about 26 in the past year or so to 19. So it's dropped about $5 in NAV. However, recently it's gone from it in the past quarter, it's up about, you know, it's up whatever that it says it on the slide what it's up in the past quarter, 39% just on NAV the past quarter. That's absolutely insane. And then you add in the 25% yield. Yes, it's not very stable, to be sure. So if you look at the problem with this fund is this. It is based on this underline right here. And this underline, the fund came out in 2023. This fund came out in October of 2023. Well, let's just look. I'm sorry. It came out, yeah, October 24th of 2023. So let's see what they were working with. They're selling options on this asset. So October of 2023 is right here. So Moderna, the parent asset, was trading at 94 when this fund first came out. Now, Moderna did go to 150, but then after going to 150, it dropped all the way down to 21. And that's when everyone was hating MRIE, was during this drop, to be sure. Now here is MRIE, and you can see MRIE for the first 6 months actually went up and was stable, but of course the underlying assets were appreciating. Once the bottom dropped out of the underlying assets, this thing started dropping like a rock. Like I say, the trend's been reversed lately. We'll see if it lasts. It'll last as long as Moderna keeps going up. It's my prediction. These things just basically follow the underlying. All right, so let's look at number 3. Number 3, XOMO, another oil and gas based one, yielding 31%. Now it's gone from 11 to 13, or almost, well, yeah, a little bit over 13, from 11.5 to over 13. I mean, it's a 13% NAV return. 1 year total return is 19%. Not super stable, but stable than some of the other things that we've been looking at. It's about half as stable as the broader market. All right, number 1. or I'm sorry, no, number 2's next. Who's number 2? Let's check it out. Number 2 is CHPY. This one is from YieldMax, yielding 36%. It's based on microchips. NAV alone is up 15% this quarter, as NAV went from 52 to 60 on this thing. Great job. The reason it's doing so well is because this whole sector is on fire, so that's great. Semiconductors and chips have been the one thing that's doing well besides oil, gold, and value stocks like DOGG and HDLB. That's kind of the themes this week. So which one do you think number 1's going to fall in? Do you think it's going to be oil? Is it going to be gold based? Is it going to be chip based? Or is it going to be value based? Well, let's see. Number 1, it is chip based, TSMY. All right. So this thing yields 50. It's based on Taiwan Semiconductor. They sell synthetic covered call spreads on Taiwan Semiconductor. That's a good business to be in lately because it's generating about a 54% yield. In addition to that, it's generating good NAV return plus 12%. Not super stable, about half as stable as the broader market, but heck, it's one stock. So really for a single stock fund, that's not the worst stable DEX I've ever seen. Let's look at TSMY compared to CHPY. All right, well, this quarter they've been performing right together. I mean, that looks almost identical. We're just going to call that a tie. One's 92 and one's 91, or the total return on one is 22, and on the other one is also 22. It's separated by 12 basis points. We're going to call that a tie. That's as close as it gets. That's just pick your poison. I think if it was me, I think CHPY's better because it's based on multiple ETFs. But let's just go by the metric. Going by the metrics, going by my own metric, TSMY has been a better play. So what I thought was interesting about the factor this week is how many YieldMax funds had made the list. I know a lot of people think I'm a YieldMax fanboy. I was 2 years ago for sure when it was there was a lot of these other ideas that hadn't come out yet, by X funds, and there's some better ideas that have come out over the past year, in my opinion. However, though, my metric is extremely conservative. This metric looks at NAV return before it looks at anything else, and then it also has a huge stability factor in here. So a lot of the YieldMax funds don't have great NAV return and aren't super stable, and they won't make the list. But there's exceptions and not the rule. And this week, TSMY and CHPY, XOMO, MRIE, GDXY are the exceptions to that. But now something else that's interesting to notice is that have anything to do with YieldMax, or is it just that these funds picked the right horse to bet on? Because you have chips, which have been on fire for 2 of them. You have Exxon Mobil, which is in the oil business. Moderna's been hot lately, and gold's been hot lately. So YieldMax is well represented there. But then we have BCAT from BlackRock, and we have a bunch of entrants from State Street also. So don't sleep on State Street. We have XLEI in the industrials yield fund. We have XLBI, the materials yield fund. We have XLEI, the energy business fund from State Street, and that is all the State Street we have. And then it's interesting, we also had 2 from Curve. We had KSILV and we had KOLD. UBS was represented by GLDI and USOI. NEOS had IWMI. So I thought it was a good list this week. I hope you guys liked it. I did this list on the show last night, but I'd made a couple of mistakes and I wanted to correct it today. So I'm sorry if you had to watch this twice, but I thought it was important to have the right information out. If you watched last night's show, I was saying that RDTY was based on Reddit, which of course it isn't. It's based on the Russell, and the Russell's been hot lately. So my apologies. But anyway, hopefully we got all that corrected, and hopefully this is a better show. I hope you guys like this. Now, remember, not financial advice. Remember, you can always remember to like and subscribe, and I'd appreciate that. And also, if you'd like to support the channel, I'll put up my PayPal right there at the bottom of the screen. But consult the licensed planner for all your needs. This metric is extremely conservative, and it shows me what I want to see for my needs. It may not be for your needs. The other thing is this metric can't predict the future. No metric can. So this metric is a good way to evaluate which funds have been the best risk-adjusted reward. But we have to take it from there and try to find the ones that are going to be the next quarter. But I'll say this: if you think that semiconductors are going to be hot, maybe you might want to consider CHPY or TSMY. If you think oil and gas is going to be hot, maybe some of these energy-based ones will be good. But remember, no matter how good the fund is, it's about 90% dependent on the price action of the parent asset to get a good overall total return. All right, guys. Well, thank you very much, and I appreciate it, and I'll see you soon. All right. Bye-bye.